So welcome to today's webinar at Tech in India, hosted by CFA Society India. I'd like to welcome all our audience who are joining us from around the world remotely. But before I begin, let me quickly introduce myself. So I'm Jay Sumer Singh, and I'm part of the investments team at Singapore Angel Network, the early stage VC arm of the Thakral Group. We're a sector agnostic fund that invests in seed and Series A companies. At SGAN, I lead investments for the fund and help manage their India portfolio. So before I introduce Sajith, some quick sort of housekeeping notes. Today's webinar will be for 60 minutes, including Q&A. Please feel free to submit your questions throughout the presentation, and you can do so by clicking on the Q&A link at the bottom of your screen. The presentation link will be shared with all the attendees after the webinar concludes. Also, don't forget to complete the evaluation survey before you sign off today. Your feedback really helps us organize high quality events and keep you engaged. Now, it's my pleasure to introduce Sajith Pai from Blume Ventures. So for those of you who don't know, Blume Ventures is a sector agnostic fund that was set up in 2010 to invest in early stage companies. And Blume manages close to $200 million of capital across its three funds. Some of Blume's marquee investments includes the likes of Grey Orange, Purple, Unacademy, and Small Case, which I'm sure you've heard of. Sajid joined Blume as a director in 2017. He calls himself an accidental VC as he was a media exec who spent nearly 2 decades at the Times of India Group across roles in strategy, biz dev, and marketing. At Blume, Sajid supports investments in media, edtech, and e-commerce. So Sajid, I'd like to welcome you on behalf of everyone at CFA Society India. We are absolutely thrilled to have you and lead this session. I'll hand it over to you now.
Great, thanks. Delighted to be here. Thank you so much. I'll get to the presentation because I know we have limited time. And so let me start off straight away with the presentation. Delighted to be here. And I've kind of interacted with a lot of CFAs. I know it's a tough exam to pass. And I've always had a lot of respect for the analytical rigor that CFAs bring. But I thought it would also be interesting for you to get a glimpse of how VCs work and how we look at valuations. It'd be kind of interesting also to kind of take you through a particular investment that we did, that is Unacademy. And it's sort of, I'll try and talk a little bit through how the valuation moved, how valuations are done, etc. But before that, I'll also give you a glimpse of the edtech landscape because it is really the sector of the day. It's a hot sector du jour. Along with that, I'll also try and give you a brief introduction to Blume itself. So that's sort of the structure that we'll take. We'll kind of talk a little bit about Blume. We'll talk a little bit about the edtech landscape. Then we'll talk a little bit about how we led the Unacademy deal. Then we'll spend a little bit of time on valuation. And then there'll be questions as well. So without much further ado, let me kind of start. Like I said, this is the flow. A lot of the work we did, and we've done a lot of work, is available publicly. And this is the link. I'm sure Jay or Vidhi will put it up on the chat. bit.ly/Blume EdTech. That's our thesis. It's public. There's lots of data. We encourage you to look at it, critique it, let us know if we're correct or wrong. We've done a lot of market sizing, so I'd love to kind of thing. And then, of course, there's the structure. So let's move on to a little bit about Blume. So part of the edtech team at Blume, just three of us who look at the sector. There's Karthik, who founded Blume as a partner. I lead the sector. I also look at HR tech. I also look at agri. I also look at B2B marketplaces. With me is my colleague Radhika. She's a University of California, Berkeley grad who joined us after spending 2 years in Valley. And she was kind of instrumental in working on the edtech thesis with me. So both of us kind of cover the sector daily. You can also see some of our edtech investments, Unacademy, the second edtech unicorn out of India, and which is led by Blume from the seed round. Metal, which had an exit to Mercer. Then there's our Fund 3 portfolio companies, Class and Leverage. So these are some of our key edtech investments. So Blume's a seed stage fund. Sometimes we also call ourselves pre-series A. And fundamentally, our core check is around 5 to 7. That's called our sweet spot. And we do follow-on investing as well. And we presently have a fund. So we don't have our own funds. So those of you who are unfamiliar with venture capital, we raise funds like a mutual fund. We raise funds from limited partners, institutions, endowments, etc., and we invest out of that. Uh, so just a little bit about Blume, and you can sense how we've grown. We started, the first fund was about 15 million. We had a small opportunity fund, which is like a sidecar fund, which invests in successful companies out of that. Our second fund, 60 million fund, small case came out of that, by the way. Turtle Mint is also out of that. So, so 60 million plus 40 million is opportunity one, which is again follow on. And fund three is the ongoing fund. This is sort of how Blume has kind of evolved. Our fund sizes have gotten larger. Our check sizes have gotten larger. The number of investments have started coming down. So we've kind of moved to become sort of from what is called an institutional angel to a proper seed fund. We typically note that of the 100 million, we get 2% of that in fees. And that is what we kind of run the kind of fund with. All our salaries, expenses come out of that. And there's a 20% carry that we get, which is on when we kind of do well, we get 20% of what we've kind of given beyond a certain hurdle limit to the LPs. So more on that separately, we can always figure out that there's enough available on the internet. Now let's go on to the Indian EdTech landscape. So this is interesting. If you look at China, for example, China food tech, if you take for India comparison, I think between Swiggy and Zomato, we do about 1.5 to 2 million. They have come down a little bit now per day. Meituan and Elimi in China do about 22 million a day, which is 10x. In e-commerce, we do about 2.5 to 3 million parcels a day. China does 140 million parcels a day. So they're like 40x. But in EdTech, the numbers are like really single-digit numbers. The gap is not as much. That's because EdTech is one of the few sectors in India where parents take money out to pay. They're willing to pay. It's growing, and it's high ticket value, high growth. So EdTech, in a way, it's sort of described as India what e-commerce is to China, EdTech is to India. And this has been our belief. And this is Gaurav Munjal saying that what will be India's Amazon will be an EdTech company. And I don't think he's wrong. And we fervently believe in this. And this has been a big kind of an underpinning of or assumption that's gone into our thesis and why we have bet aggressively on it. But if you look at it, for example, EdTech is a small part of education. That EdTech is when technology is used to deliver kind of education, and it's started globally. EdTech is about 5% of 5.5% of education. So education is about 7.8 trillion, and EdTech is about 400 billion. This is as per Holon IQ, which is like the Gartner of education. In India, it's much smaller. Right now, EdTech is barely 0.5%. We expect it to go up sixfold to about 4 billion and to hit about 2.5 to 3% of the market. The data on this is available on our that bit.ly link that I shared. You can have a look at it. We've also segmented what EdTech is into different buckets. There are two buckets that are really large. One is the K-12 after-school tuition bucket, which is where largely your Byju's, an academy, Vedantu all compete. And the other is continuous learning, which is where your upgrad, etc. compete. In fact, CFA Academy is also in a way an EdTech company now, and they compete in the continuous learning space. So I'll just go to the next one. This is really how we look at the EdTech landscape. All of this is there on the Blume EdTech thesis. Fundamentally, it's a complex slide. Let me just navigate it for you. We can actually see it as at the top, there are two halves, the top half and the bottom half. The top half is formal education, which is degree giving, accredited institutions. The bottom half is informal education, so which is not necessarily recognized by the government. So hobby classes, tuition, all come in there. Preschools all come in the informal education space. Then you can divide it by age. So depending on the age, there are different products and needs. The needs and the different products taken into it. So that is sort of the landscape, and what we have done is to also give you the size of those boxes, and we've tried to give you relevant companies in that space. So Baiju, for example, is an informal education K-12 schools space. If you look at Exceed, or Lead School, which has a product for schools, they are in the B2B space for schools. So they're where Educom Smart Class would be. So this is sort of the landscape, and if you go through it, we'll also give you a sense of what we mean by these names: B2B, B2B2C, and unbundling, etc. When you say like unbundling, for example, is very simple. Unbundling is when like you go and let's say company can go and say, hey, we'll do a robotics class in schools, and they offer that robotics class to one school, and then they offer it to multiple schools, and then they kind of become a product layer on that. So that's what's called unbundling, where you take out one core product from schools or colleges and kind of bundle it out. I'll now move to Blume's EdTech journey, it's interesting in venture. Venture is a very interesting kind of space, and it evolved. And there's a fascinating book that came out called VC and American History. And I was fascinated to read the first chapter that deals with whaling, W-H-A-L-I-N-G. Ships going out to chase whales in the 19th century. And it's fascinating how much of it resembles VC of today, like similar carried interest, and it's fascinating. And the reason I hark back to that is, historically, venture has been about risk, and it continues to be. And one of the peculiar rules that has come into our industry is that 7 to 8 out of 10 investments die. It's an ironclad rule of venture, and that in the 25 to 27 investments that we do, there will be about 15 to 20 which will die. And you don't know which ones, but they will die. They will take risks and they will die. The remaining 7 to 10 are what will give you your money back and more. And typically, there is one out of that which delivers more than 100% of the fund, sometimes even 200% of the fund. So this is one of those ironclad laws of venture. It's a power law, and typically what we have seen is, the more you try to even out the risk, more you end up having no companies which give you great returns. The best way to succeed in venture is to take higher and higher risks. So all of these companies at the top, barring Unacademy, have died. They've all failed for us. Other than, of course, so Sparsha has died, School Shop has died, Mockbank has died, Pagal Guy is like struggling, Flip Class has almost died. Of course, Class Plus Mastery exited to Unacademy. So Class Plus and Leverage are continuing, Unacademy has gone now. Below Metal we sold. Scalenza and Frap are younger companies struggling a bit. So point I wanted to say is, even though we try to do pick company, pick this thing, we will have failures, okay? And sort of the journey has been to kind of learn from those failures, hopefully not repeat the same mistake. But at the same time, you've got to be very clear when the market is changed. So, for example, School Shop failed because we tried to use a school as a distribution platform. But again, we've invested in a company in Fund 3, which does similar. So, hopefully, we'll not commit the same mistake because we feel that schools are willing to pay now. So point I wanted to kind of say is that while we've done a lot of EdTech investments, we haven't succeeded with too many, but the ones we have succeeded have done really, really well for us. So, and that's the nature of the business. I won't go deep into any of these, but you're free to kind of ask me questions as, So how do we approach edtech investing? And the last slide before we get into the more exciting parts. So we kind of, out of the 100 million fund, we can do about, so the way a fund works is very interesting. Out of the 100 million fund, 20% go in the fees. I told you about the 2% that we get every year. So 20% goes in fees. So you left with about 80 million. And out of the 80 million, you've got to keep a reserve ratio of 1:2. So what do you mean is that we got to do follow-on investing. So the first check is typically 27, we have about 27 million for the first checks. So typically given our sweet spot is 1 million. So we can do about 27 investments. And then we keep the balance for follow-on investments when the next round, etc. happens. So about 25 investments, we can do max about 4 or 5 in edtech. You can't do everything in edtech. And to look at what we've done is, if we go to the edtech cases, we've actually broken down edtech into multiple buckets. And we have put one investment in each bucket. So that's how we kind of look at the space. And okay, so that's how we work. Maybe in the next fund, we may not do as many edtech companies, maybe fewer. Yeah. So Unacademy, that brings me to Unacademy, and then we'll spend a little bit of time on valuation. Yeah, so Unacademy, we invested in them when they were when they came to us, they were a YouTube channel. And it's interesting that in venture, today they are disrupting Allen and Co, they're disrupting FitG, etc. But they started off looking like a YouTube channel. And this is interesting. So what is going to disrupt you will never look like what you are. It looks something completely entirely different. And for about 2 years, they focused a lot on content development. They were a YouTube channel, they grew their audiences. They didn't monetize for about 2 years. And finally, they raised almost hit 100 million valuation, at which they started monetizing. But it's been an amazing, blistering pace of, unfortunately, because it's going to be publicly put, I can't share the numbers. But it's extraordinary growth in really the, I would say, the ARR, and really in Jan 20 before COVID, they raised a round and incredible growth and numbers and stuff like that. Okay. Yeah. So what led us to kind of invest in is that we were exceptionally wowed by his product skills, product and content marketing. That was exceptional. They had an exceptional understanding of product. There were also macro tailwinds blowing into it, the rise of the smartphone. We invested in them before Jio, but smartphone was growing, and they really benefited from the Jio tailwind, which even we didn't anticipate. We're able to help connect them to great investors, but fundamentally, the founders executed incredibly well. And they executed incredibly well. And I think that is really at the heart of it. There is a good way to look at it. There are two kinds of founders you meet. One is founders who have a very strong strategic product mindset. Second is founders who have a lot of sales aggression and they kind of bend reality to their will. Very occasionally you'll come across a founder who has both, and that's Gaurav Manjal. So that's the story of kind of Unacademy, I used to know. So it's a little bit about how that fundraising has moved, and sort of like gives you a sense of how kind of they raise. So almost every 9 months, like I said, they kind of raised, and this is how valuation has moved. The last two rounds were 100 million plus rounds, and it's incredible how. And I'm going to use this to kind of illustrate kind of the next slide on valuations a little bit as well. That's why I kind of put it here. But yeah. So I'm going to spend about 5 to 10 minutes on this slide. It's about kind of valuations. And Jay, this might be a good point for you to kind of prod me if you have any questions, etc. Because this is really at the heart of what I'm going to do today. So if you look at valuations, and we do have a CFA, young CFA in our midst. And yeah, so so when I interviewed him, I asked him, like, how will you be able to kind of use your valuation at this stage? And he told me a little bit. But, I told him that, at our stage, valuation is actually, you're not going to use any of your techniques that you have kind of learned. So valuation is, at our stage, is how can you evaluate a company? It's just, you're basically starting the product. Your product, you can't project anything. Like you can't, there's no point in projecting kind of growth, because growth can be 100%, 200%, 300%. So it kind of reminded of this wonderful kind of tweet which said that the best fiction is written in Excel, not Word. And I'm always reminded of it when I look at Excel sheets at the early stage. We don't take Excel sheets very seriously because it's a bet. So at this stage, it's really down to fundamentally looking at the capital that the company needs to reach the next stage and how much we can dilute. So typically at Blume, you give 1 million, we will need at least 20% equity. And so the valuation becomes 5 million. So pre-money 4 million, post-money 5 million. So 1 on 5 is 20%. So it's fundamentally, so if the company says, no, I can get to the next stage, which is, I can go to a series A using 1.5 million, but we need 15%, then it will be 6.6 million. Like, so 1.5 by 0.5, whatever. No, or 10 million, sorry. 1.5 by 1.5 million, 15% will be, the pre-money will be 8.5, the post-money will be 10 million. Now, you will say, wow, like, it's just like that, like you're just deciding like that. No. Like I said, there's an art and a science to it. And the science is that if you look here, there's an interesting pattern of roughly 2 to 3x multiple between each post-money stage. So these are rough thumb rules that the industry holds, that your numbers should improve by 2.5. Metrics should improve by 2.5, and valuation should also improve by 2.5, or maybe more depending on this. So this is kind of a science. This is kind of an art it's involved. And what we do is at every stage, we work backwards and we look at what the rough revenue, if there is revenue, we look at revenue. Typically, the way we look at revenue is we look at the last month's revenue multiplied by 12. Because typically revenue is growing 20-25% every month. So you can't do trailing 12 months. You take the last month's revenue and multiply it by 12 to get the average annual recurring revenue or annualized revenue, AR. So basis that, we look at what the multiple is. Typically, look, it all depends. If it's a very hot company, sometimes the multiples can be 12 to 15x, 20x also. But typically in EdTech, it's 6 to 12x. So you work backwards to see what the multiple is. And it sort of work backwards. And there are thumb rules again. The higher the gross margin, the higher the predictability, the higher the growth, the more the self-serve. Now, gross margins come here. The more self-serve it is, the higher the gross margins are. Not necessarily, but yeah, we should have put gross margins there also. So I'll probably share an updated version of this deck putting in those. So the higher the revenue quality is, the less predictable, lumpy revenue is, the slower growing it is, the more it is like a service revenue. It's not scalable, it's not productized, it's not self-serve. Then the lower the revenue quality is, the more it will be towards 4 to 6x multiple. So these are all indications that we have, because fundamentally in venture, we look to back businesses that are high scale. So the idea is that every incremental customer you should be able to serve at very little cost, and you should be able to acquire customers at low costs. So, and given this, we look at these 3-4 factors to look at what's called revenue quality. And basis that we look at the one. So typically hot startups like Unacademy typically are high growth, have predictable revenue. There is revenue that's booked for a year, for 12 months. You know that money will come. It's self-serve. Nothing has to be done. It's very productized. So it's one of the highest. And that's why it gets the highest multiple. So what happens is, as you move from seed to Series A to Series B, Series C, slowly what happens is the multiples get less and less richer. Because more and more of the growth is now priced into the company. And growth starts slowing down. Of course, if the growth continues, it can keep growing. So as you move beyond, now look at it, the multiples come down, and by the time it comes very close to like how what by the multiples start mimicking public market multiples. They start mimicking pure companies in the public market which are listed. What are they trading at? Can't be a very big gap usually. And this is sort of how this particular one goes. So, sort of the idea here is that as an academy as keeps raising, every investor also does one thing. They look at the next investor is going to come in. Will that investor come in at 2x what I'm coming at? So now look at GA. GA came in and said, like, what is the next investor coming? They came in at 2.5x I did. Similarly, Stevie got a 2x multiple. Each party is seeing a 2x jump. And so that's how we behave. Every time we kind of invest, we're also looking to who will come next. So it's sort of a well-constructed pack of cards, or sort of a domino you can call it, where if you go in the middle and suddenly give any bizarre thing, like let's say suddenly there's a company which we funded at, let's say 1 million. 1 million we gave them, and we funded, post-money valuation was 5 million. So we took a 20% stake. The company does very well. Now the ideal multiple would be a 2.5x of 5 million, let's say 2.5 to 3x, let's say 15 million post or 20 million post. But if someone comes in and gives like a 50 million post, the company grows 10x. That means now they are expecting this company to grow to 150x the next round. Now, will it grow? Will it be if it grows, it's great. Else, this company would have kind of done a fairly bad thing. So it would not have got a big kind of a jump. And then what happens is, once a company comes in at 50 million, and then anyone who's coming in, if the multiple jump is less than 2.5x, they're also seeing, is there something wrong in the company? Is there something wrong? So there are sort of norms established to kind of make sure that things don't go completely out of whack. So sort of it's like I said, it's an art and a science. The more early stage you play in, the more it's an art. As you get towards late growth, what's called venture growth, like a Bessemer, like a Norwest, they bring in a lot more science into it. They look at public market comps as well. But eventually, public market is sort of the gravity here. But these days, when public market valuations have gone a little berserk, so I don't know what to say. So Jay, I think I'm kind of at my last slide. So I can kind of drill deeper into something, or I'm also happy to kind of do the Q&A now, because I thought this sort of would be the most interesting thing for folks. So yeah.
Yeah, Sajith. So is this your last slide?
Yeah, this is my last slide. I think it's my last slide. Yeah, no, I have one more slide. This is something that I kind of kept actually. I forgot I put this. It's actually an interview by Chamak Palihapatiya. Chamak's early stage investor, runs a fund called Social Capital. So Chamak said something very interesting, and this is something I would love to get your reaction. In fact, So if you have questions, I have one question. So what Chaw's saying is that, and he's fundamentally saying the days of value investing are gone. Because historically, when value investing was invented by Graham and Benjamin Graham, let's say, he was one of the pioneers of value investing. And sort of the CFA owes a big debt to Benjamin Graham. Money was scarce. It was a Great Depression. And sort of the great value investors came out of that era. But today, money is cheap. There's lots of money available. So, and sort of the value has moved from tangibles to intangibles, like Facebook. What is intangible? Is it the brand? Is it the data? Is it network effects? So, sort of something that increasingly we also look at, because we also get worried by valuations jumping. Like in COVID, I'm not kidding. When COVID began, we all thought valuations are going to come down. Some of our companies which got a 25% discount to the kind of the term sheet, they got renegotiated. But you'll be very surprised to know today valuations have gone up by 25%. And many companies have done very well, and it's strange. So we also wonder a lot, even in venture, that even when we give these, are these valuations realistic, etc. But we find it very strange. We find two things very strange. One is, of course, post-COVID valuations, etc. have gone up, and there are real reasons for that. The other thing we are always surprised with public market comps. I mean, they have gone a little thing. So I would love to keep this interactive and maybe get one of you to answer this question. But I think this is my last question.
Got it. Thanks, Sajith. That was very insightful. We've gotten a few questions from the audience. So I'll just start sort of taking them one by one.
Yeah, just one point. I'll actually update the slide and send it to you immediately after that. Please put that slide, those up if you can.
Sure, okay? Sure.
Unless you've already put it, if you can just delete it, and I'll give you a new slide, this thing to put. That is, okay.
Sure, we'll take care of that, Sajith. So let's address the most common question in people's mind right now, right? How do startups who burn so much capital, lose so much money, are valued at multiples that seem almost absurd to most traditional investors? Someone just pointed out that Byju's is at 11B, 10B right now, revenue multiple of 30 times. How do you sort of make sense of all this?
Byju's not at revenue multiple 30 times. It's less than that. Okay. If you look at Shopify, if you look at Uber, of course, Uber has done badly. If you look at a lot of those kind of companies, any transformative company, Facebook, if you talk to the investors who invested in it, and you should actually check out these Bessemer has set up the investment memos, the original Shopify investment memo. You should see the YouTube memo. In every single one of those cases where the company has been a breakout hit, the revenue was woefully undersized. They estimated much lower revenues. The fact is, when a startup becomes a breakout hit, it transforms the industry. And this was a whole debate between Ashok Damodaran and Bill Gurley. Ashok Damodaran said, look at Uber. Uber is going to be a percentage of the New York cab market. Like, it's going to be 20% at best, 30%, 50%. Even 50% will be so much. But what Bill Gurley said was, if people like it, they'll actually stop buying cars and it'll be a share of transportation. And that is sort of what has happened. So the way I would put it is, revenue is a kind of, and our belief is growth. Our belief is that revenue, look, it's like price earnings multiple. Why do certain things trade at 70 price earning multiples? Why do certain things earn at 40 price earnings multiples? The belief is that earnings will go up. That's a belief, right? You're not going to wait 78 years for it to pay back. The belief is that earnings will go up. It's the same with us. We believe that revenues will go up dramatically. And if you look at Unacademy, no one expected that they would have jumped 50x in revenues from the first month, or 60x in revenues, probably like 75x in revenues in the space of 1.5 years. So in the space of 1.5 years, they've jumped 75x in revenues. Who could have expected that? Who could have thought of that? So revenues is a misleading indicator Growth is the key one, because if you're going to double every year, it's exponential. So, so that is the simplest answer I can give. That fundamentally, it's complex, and I would want you to look at it from an open mind. When we look at public comps, which are slower growing, it seems a little absurd. Yes, it is absurd going by that line. Yes, these are immensely unprofitable, but they are fundamentally in the business of they're buying growth. And the belief is that you will grow. If you look at the unit economics tend to be positive at a gross margin. Sometimes the gross, like for example, we have evolved our own unique measures. So we have something called basically sort of one is the gross margin, then there is contribution margin, where you take a look at advertising, then you look at logistics costs, the CM1, CM2. So we've evolved our own interesting frameworks. And typically at the gross margin level, they're always positive. What brings you negative is customer acquisition. It's sort of what we call, so we distinguish between good burn and bad burn. So bad burn is when I have to pay you to come and use my product. That even offer the product to you is loss making, but I cannot pay you to even consume the product. I would say good burn is when intrinsically the product is profitable and I'm buying customer acquisition through it, and you'll stay with me long enough. So it's a fairly, I mean, I don't expect it to be immediately understood, but we are in fools. There is logic behind it. And the fundamental belief you have to keep in mind is that not all startups will do well, but we'll only lose what we have put in. Typically, a good startup gives you 50x to 100x of what you've invested in. And, so Oyo, for example, has returned Lightspeed 35x of what they invested. So good startups do. So those are sort of the beliefs, but I can actually try and clarify it if people are not yeah. But fundamentally, growth takes care of a lot of things. Yeah.
Right. No, I agree with you, and I think since I am kind of like straddling between the traditional school, which is obviously the CFA school or the value investing school, and the growth school, in wherein we're chasing growth as venture capitalists. And it's funny because you talk about CM1 and CM2, and there's Warren Buffett who calls even EBITDA bullshit earnings, right? So a really interesting point there. But power law is the supreme law in venture capital. Now, Unacademy has had what, 8-9 rounds. You've led the seed round and then participated in every round post that, which is incredible. But I just kind of wanted to pick your brain here that. Once you've recognized that there's this company with a great founder, with a great team, that's building a great product and is on its way to that power law, do you maximize your ownership at a Series B and a Series C, or do you continue paying up when you've already recognized that this is a great company?
Yeah, so typically what we do is, let's say we got to a company and we hold say 20% at our stage. We invested 1 million and we hold 20%. Next round, let's say, is 5 on 15 pre. Okay, so we have pro rata, so it gives us the right to participate and maintain our stake. But sometimes in a hot company, it can be very hard to get pro rata. In Unacademy, we have struggled to get pro rata, so our stakes have got diluted. So it's always a challenge to get pro rata and this one. And I would say that it becomes more and more expensive to buy ownership at later stages. So you've got to buy as much as you can early enough. So and you also don't have too much money because if you're a 100 million fund, you can at most put $5 to $7 million into the next round in the next 2-3 rounds. So by the time Series C comes, you don't have much money. So seed investors like us have to go for everything very early on. At best, you get a chance to correct it in Series A. Beyond that, it's very hard. Valuations just go up. So to hold, if the Series B round is a 10-12 million round on 40-50 pre, 20% of 50 million is 22 million. Okay, still possible. Series C out of the question. 30 million, 20 million round, to hold 20% would be 6 million. Be tough. So yeah, I would say that we try to maximize ownership as early as possible.
Right. And a, a common way to like look at venture capital investments is like a call option, right? Due to like the non-linearity of bets, wherein the maximum you lose is your investment, but if the company is truly high potential, it can return the entire fund or even multiples thereof. So how
Yeah,
do you
it's
think
called
of?
a dragon. When a company returns the entire fund, it's called a dragon. So, for example, if I invest, like say, there's a company which is valued at let's say 1 billion, and I hold 10% of that. 10% of 1 billion is 100 million, and my fund is 100 million. So this is return the fund. So it's called a dragon. Dragons are more important than unicorns. Yeah.
So my question was at an early stage, right? At a seed, pre-series A stage, like you mentioned. How valuation insensitive are you early at that early stage? Because I think Karthik posted on his Medium when he was talking about an academy that that was probably the highest you've ever paid for a seed investment.
Yeah. So see, uh, ideally, you don't want to kind of lose a good deal for pricing, because if this becomes a blowout hit, whether you have done $5 million or $7-8 million doesn't matter. Like, so if it's a pre-money of 4 or pre-money of 7, really doesn't matter if it becomes a unicorn. I would say, but still, what happens is stakes come down. So you want to balance stake. And typically at Blume, the thing is, we are willing to relax on the valuation, but stakes are important. But at the same time, this equation can break. Like, someone can come and tell you, I want 9 million pre-money, I want 9 million pre-money. And Blume may not be able to invest more than 1.5 million, in which case the stake will be 1.5 by 10.5, 1 by 7, which is 14 odd percent. So this is kind of a trade-off. So I would say that ideally you don't want to lose a good investment for money alone, but you don't want to lose too little stake also. So yes, given a choice, hot deal, hot company, you believe it will do well, don't lose a deal. Pay a little bit more. Yeah.
Right, right. And how do you then look at the 2 or 3 800-pound gorillas that you have in edtech? You have Byju's, an academy, Vedantu. How do you look at upstarts or new companies, new entrants to kind of build themselves up and scale when you already have these 3 behemoths in this space?
So we can't invest in newer companies in that space, and that's a challenge. And I think some of the newer companies that's really beginning to get not easy to get funding, and so this is one challenge they're beginning to face. And increasingly, I would say that if you're a tech founder, be careful about going into a space. There are these 800 gorillas. I'm not saying you cannot play there because you have a license to play, but do you have a license to win? Because capital is going to be hard to come by, etc. So what you want to do is look at someone who has an orthogonal approach, and that is why we look at Class Plus. So Class Plus doesn't compete directly with an academy or Byju's, but it provides kind of a platform to institution center owners to offer learning content, live classes, and slowly it is now building a content marketplace, and slowly it can build an assessment marketplace, and so on and so forth. So you want to look at someone who's orthogonal approach. So the competition to an academy will never look like an academy today. It will look like something else entirely. Like how an academy looked like was a YouTube channel, and now it's taking on a 5G. So what competes with you, what is succeeding is something which doesn't look like anything. It could be a fintech product which suddenly says it can offer assessment, or it could be an assessment company. I don't know.
Right, right. And if you were to sort of evaluate and look at an academy's moat right now, what would you say that truly that true sustainable moat is?
Yeah, so I'm not a big believer in moats because in tech, moats came about, and I think Warren Buffett kind of popularized this term. Moats are great when you have slow-moving industries, 3%, 2% growth, and sea candies of the world. And you want to see if somebody will come in and disrupt that. And typically, moats are a kind of a great way to understand traditional industries. In our space, I think tailwinds are more important. How fast a company grows is more important. So you want to be on the right side of a tailwind and be kind of carried by that, as opposed to building moats. And I would say that, you know, yes, there can be modes. So modes could be, for example, switching costs. If all your data is in one tech thing, all your assessments are there, then for you to go to another place and begin all over again would be a challenge. So your data your data is a mode. If you have adaptive content which learns as you start practice running, that is a mode. Your brand is a moat. Okay, and so I would say that brand, of course, even buffet says is a moat. So I would say that I'm not a big fan of moats per se. I'm a much bigger fan of tailwinds because our entire business is predicated on growth. So I can afford to get away with paying, I mean, what I call absurd multiples because I believe that we grow. I believe that we'll grow like 50x, 60x. So I need the growth to keep firing. So in the valuation thing, if you break down valuation, the valuation premium, the highest for growth, then for gross margin. So it's not the other way around. So and why we are scared by profitable businesses is very funny. So sometimes when founders, and typically you get to see few businesses are very profitable in tech. They come to us and they're almost scared. They say, it's not profitable, right? No, it's not an issue. So the reason is profit is a sign of the market getting stabilized. So it sort of, you're not investing anything in growth. That's the way to see it. So if you can look at everything from that filter, you'll kind of understand. So when we look at the company that's profitable, and we typically also see growth slowing down. It's very rare to see a company that's high growth, high profit. Yes, hota hai. When it happens, wow, like, you know, so that's like that's probably like a Zoom perhaps, right? But or Microsoft or Google. But otherwise, you have very few companies like that. In India, I haven't seen too many such companies. The reason you're unprofitable is because you're chasing growth, and growth is coming. But you're not chasing bad growth; you're chasing good growth.
Right. Very interesting point on being able to chase tailwinds. Do you think the ability to chase tailwinds is a function of where you are in your life cycle and how much capital you've raised? Because these tailwinds were consistent and common for the entire edtech sector as a whole, right? But we see only a few truly sort of leverage these tailwinds. So what do you think were the factors that enabled them to leverage these tailwinds, and do you think those factors become the moat?
Possible. Being in the right place at the right time. Capital is a moat, you're right. Having an academy raise money in Jan, money hit them in February. They had got 800 crores in the bank and COVID began. Like, it's incredible. They were like the best place. They had money, COVID, crippled, they went all out. So you get very few opportunities like this. There's a lot of luck. When you have it, you have to kind of go for that six. So you're absolutely right. Being in the right place at the right time, capital, all of that helps. I think luck is critical. We all, venture, you can't predict how some of these things turn out. Luck matters a lot. But at the same time, I think founders also, good founders also are very strategic about it. They see trends, they see direction, they see customer problems and see solutions. They see two years ahead. And hence, I would say, like Class Plus, pick the space which is now taking off, like anything. Like, you know, like, because a lot of the tuition centers, like Class Plus is a great example. They were selling software for tuition centers, ERP, learning management. They had a particular product which is about live classes. They're never, the basic product, rudimentary product. And when COVID came, they were the right company to do that. Okay. And today they do 7,000 live classes a day, like on their platform. And so sort of you can tell me, were they lucky? Yes, they were lucky. But the founders totally built out this product portfolio. And COVID came and they were in the right place at the right time.
Right.
You know? So sort of like that, yeah.
Right. Also, there's obviously the hot topic is the ethical side of edtech, and specifically the aggressive selling of edtech, right? How do you like make sense of this, and what are your thoughts on this?
Yeah, I think it's kind of like fairly aggressive marketing. I know what you're talking about. I think Customer feedback is, I've seen Karan's email, messages in LinkedIn, etc. I think they're re-looking at that a lot, and it's great. He's sort of coming in and playing from the front foot, which is very impressive. He's listening to customer feedback. Look, we're an aggressive business. Startups do make mistakes. We do have aggressive goals. We do push. When we push, sometimes things go wrong. Yes, at the same time, we correct fast. Nothing is cast in stone, and we do course correction very fast. And sort of this speed is an incredible asset. Maybe speed is a moat as well. And so I would say that, yes, occasionally we get it wrong, and we look to our consumers to tell us what is going wrong. We look to media, we look to observers to tell us what's going wrong. And invariably, you'll find that we correct very fast. I'm not saying we are gods, we are we cannot be nothing can be cast on us. Yes, we make mistakes. And that is what startups are about. 50% of what you do fails. Because you're trying to grow, you're trying to delight customers, so sometimes it's always a trade-off. But you can't trade off, right? You can't trade growth for quality. You can't say, no, I will have to grow anyhow, but let's get them on board. So good founders invest well beyond very early X, Y, Z. So I don't think there's an easy answer to this. Yes, occasionally we screw up. That's true. But we course correct. Yeah.
Right. Fair enough. I think when you're moving fast and breaking things, it's tough to fix the rocket ship midair, right? But it does
happen. There's a lot of questions come up. I'm sure you will cover it in a bit.
Yeah. So Utkarsh has a really interesting question on distribution being pivotal in D2C at tech. So, just wanted to understand how you believe early stage companies or new entrants can lower their CAC to be able to compete with bigger companies and bigger players.
Yeah, that's a great question. So, in fact, Class Plus and two other investments we have done have all been very interestingly in EdTech having B2B2C investments. So, Class Plus is a classic example. I can talk about it because it's public. They don't acquire customers directly. They tap their customers. So they for example, there is a Dayal classes in Ludhiana, who's a chemistry, physics, whatever, 12th class. So he has 400 students. So on the app, when the students kind of come and start using it, Class Plus gathers data. And they can offer tools to this person like assessment, content, etc., which Mr. Dayal can push out into to the students and get a cut. So sort of B2B2C has been a very favorite thing for exactly the same reason Utkarsh said. Acquisition costs are very high. I look at some of these pitch documents and know what upgrade is spending. As much as 25% of gross service value or gross GMV of EdTech is spent in advertising, and this is going to Google. That's very high. And hence, I like to look at models where it's a B2B2C, where you sell a B2B product and you can then tap the customer's customers. So this has been a favorite topic of mine. And increasingly, this is becoming a challenge as well for many companies. Yeah, and Utkarsh is absolutely right. We worry about that. And I would say that any advertising model where the CAC is not coming, any model where the CAC is not coming down, I would be very worried. I'm okay with CAC being very high at the early stage, provided we begin to see CAC come down. Because what is scale? Scale is where every incremental customer should be acquired at zero cost, and every incremental customer should be served at zero cost. The best businesses are these businesses where the extra customer costs nothing, like network effects. You have to go to Insta because all your friends are on Insta, or you go to TikTok, not necessarily, but you go to Insta because all your friends are there, or Facebook because all your friends are there. So the more people, more of your friends who are there, the more you will join. So these kind of network effects matter a lot. And so we like businesses like that. Yeah. So in short, Utkarsh is right.
Yeah. So Praveen has another question, so sort of just leading on to network effects. How would you allocate different intangibles and the qualitative aspects within EdTech, and what do you think that differentiating intangible is? Is it technology, collaborations, brand, network effects? What is it?
Okay. Uh, I think in EdTech, there's a product, and the product is fundamentally digital delivery of education. So the outcome matters, and outcome is efficacy. And the intangible is the learning tech. Like, for example, how you clear doubts, like how you structure the program, like calendaring. Like, if you, like, why live classes matter is what's called calendaring. Calendaring means like why we go to gym versus why if we work out alone. If you work out alone, we'll always have an excuse. We'll not go all out. But when you're working in a gym or working on say CrossFit or in a group, you will never slack. So similarly, in a live class, you will not slack, okay? Because it's a live class, etc. Of course, you can watch the recording later. Doubt clearance, separating our doubt clearance and this thing. Then community, having a community, etc. Doing assessment. So there's a lot of learning tech. Different startups are built out differently. So Vedanta uses something they call it WAVE, where they measure as many as 78 parameters, including how your eyes blink, etc., etc. Like they send out which is boring. How classes are structured, how videos come, when the professor intervenes. So there's a lot of trial, like, which is done. How long the videos should be. Like, there's concepts such as interleaving, like how you mix concepts so that learning becomes harder and learning becomes better. It's strange. The more you make learning harder, the better learning is, remembering is apparently. So there is a lot of science behind this, and the intangible is fundamentally the way you put together. So it's sort of like Disney and Pixar, right? They're making similar movies, but there's magic in those movies because there's a lot of creativity and this thing that's gone into it. So I would say the biggest intangible for learning companies is your learning tech. How your technology works with the product, with the UX, with the flow, with the content to give a complete experience to this one. So if you tell me, is it UX alone? No. Is it is it like how you build the community aspects of it alone? No. But the bringing together of all those, and look, there are multiple ways to make it work. I'm not saying that only one company has. There are multiple approaches. Some stress something else, some stress something, but it all kind of works out. But yeah.
So, very interesting point, Sajith. Now, you presented a great sort of a sector landscape slide in your presentation. There are a couple of questions around which sub-segment within EdTech are you the most excited about, where potential unicorn would sort of come out of, which hasn't been touched so far.
Yeah, it's a great one. So continuous education, which is continuous learning, as basically like an upgrade is, you'll see a unicorn there. Could even be upgrade. Great learning is kind of there. So you'll start seeing that. I think the one space we'll start seeing a very interesting play is higher education to jobs. We see it is a very interesting space. We just bet on a company in that space because reading a very interesting stat, there are as many as 6.5 million Indians who graduate, but there are only about 500,000 white-collar jobs. And it's astounding. So 6 million go without great jobs. They do average jobs. So it's getting very competitive. So upskilling in that college to job space, assessments in that college to job space, all of these are we're likely to see growth take off. So I'm very excited by this college to jobs and early working, upskilling, which is sort of where upgrade is, this space. So we kind of look at career starters, career accelerators, etc. So career starters are people in the first 2 years of their career. Career accelerators are people immediately after that. And there are career switchers, etc. Yeah.
Right.
So that's
right. So since we're a bit over time, I'll just ask the last couple of questions and sort of moving back to valuation again. Sajith, how do you sort of see this valuation change of 2 to 4x, in between rounds? Does this suggest inefficient value discovery by founders or, the investors who sort of invested in the earlier stages?
No, because the metrics have gone up, right? The metrics, see, we are giving them, see, what are we giving them money for? We are giving them money to run experiments in the pursuit of growth, to get to scale. Venture is the business of building high-scale startups, right? We are in the business of betting on startups which become very big very fast. The only way they'll get there very fast is to run experiments. So what are we giving them? We give them money, like we give them $1 million and we tell them, please focus on investing those $1 million. The burn, that is the revenue minus costs that startups have, is the strategy. Your strategy is the burn, is where you allocate burn. That's your strategy. That's the only thing that's in your control. So we want you to take those high risk things, and typically you're buying audiences. Hopefully you're not only buying audiences, you're also buying engagement. Hopefully you're also not buying engagement, you're also buying trial. Hopefully you're also not buying trial, you're also buying revenue. Hopefully you're also buying high gross margin revenue. Hopefully you're buying high gross margin, high predictable revenue. And hopefully you're buying high gross margin, high predictable, high growth revenue. So when this happens, the investor who's coming in is also re-rating the business. So when you invested, we had like 3,000 or 4,000 people on the app, revenue of 20-25 lakhs or revenue of 20-25 lakhs a month. And now suddenly when it comes to the next level, it's already at 75 lakhs to 1 million, 1 crore a month. So revenue has also grown, right? So you're fundamentally linking it to that the business has grown this thing and business has got de-risked. Don't forget, the say the risk has come down to the business.
Right.
So Blume can also kind of move along that route. So there's a risk curve, right? Risk valuation curve. The more earlier you come in, it's a tukka business. You don't know how it can go out. The more later you come in, a lot of the risk is taken out and growth has also been priced into the company. Okay. So it is value discovery. It's not inefficient. It's just that the kind of markets you're playing in are very different. The seed stage market is very different from late growth market. So like when Cotu and Silver Lake and all of them invest in Reliance or someone like that, it's a very different kind of investor. That mindset is very different versus how when we invest.
Right. So how is it that, you see sort of examples of, even growth stage deals not really working out? How would like a late stage investor make mistakes like WeWork? How do you sort of think that happens?
Yeah, no, so that's a specific case. Look, in fact, it's scary at late stage. I know how private equity companies, if we were head private equity, you will have about 10 to 12 investments you can do. And if more than 2 go wrong, you will struggle to return the fund. So I can completely understand the challenges thing. Mistakes do happen. And a lot of these mistakes are now spurred by cheap money. And SoftBank is a class act in itself. I don't have anything more to say. But not just WeWork, there are expensive mistakes which happen at Sing as well. There are at least 2 Indian unicorns which may not remain unicorns if they approach the next round of funding. So there are companies, there's a large Indian healthcare company which the valuation dropped by half when they went to kind of raise. So these situations do arise. It's unfortunate when they happen. Mistakes do happen, and it shouldn't happen, but it happened. It's very hard for me to sit at the early stage and criticize.
Right.
Maybe they saw something in it and didn't take off. That's what I can say.
Right. No, fair enough. I think luck has a very sort of a big element, right? Even if it's early stage or late stage. So yes. All right. I guess this is it from our side. Thanks so much, Sajith. Thank you so much for sharing your insights with us today. All the attendees, please complete the evaluation survey, and you can claim your professional credit by logging on to the CFA website. Thank you for participating in today's webinar, and thanks again, Sajith. Thank you.